Hey everyone, welcome back to the show today. Today we have Laurits Just with us today, former founder of BitsForDigits and now currently operating Flippa Invest. Welcome to the show.
Thank you so much, Jason. Happy to be here.
Let's go straight into it. What was BitsForDigits?
Yeah, BitsForDigits was a partial acquisition marketplace. So you've heard of full acquisition marketplaces like Flippa or others. And we were taking a different approach in that some founders were looking to sell a piece of their business in a secondary, but weren't interested perhaps in selling all of it. And that was the initial concept for BitsForDigits and what we did for a few years before also allowing full acquisitions, but we can get into that.
So why did you end up starting BitsForDigits? And did you raise money? Did you bootstrap?
We bootstrapped it, and we started BitsForDigits actually after being inspired by a blog post by a guy, David Heinemeier Hansen, DHH, as he's also known as, who's the CTO and co-founder of 37 Signals, including Basecamp, and how, like, the blog post was basically about how they sold, him and Jason, his co-founder, sold a minority stake to Jeff Bezos in a secondary. And so we were like, well, not everyone has Jeff Bezos on speed dial. Maybe we should create a place for primarily SaaS founders to do the same thing with high net worth individuals or strategics. So that's what we did.
It's a pretty interesting inspiration story.
Yeah.
And ultimately, where did you get how far did you take BitsForDigits before you ended up selling it to Flippa?
So we got to a point of profitability first and foremost, and I mean for the first year we were basically using our savings, which we had saved up like working corporate jobs. But then we also got a bit of funding in Berlin, in Germany, where we founded it. But we got to a place where we had like word of mouth, which was important. Because that helped kind of relieve some of the direct sales that we were doing, outreach and all of that, and to a point where we could like safely assure founders that they were going to get like a bunch of like negotiations started when they listed on the platform, which wasn't the case in the beginning. In the beginning, it was very like crickets. So that was it's tough to get a two-sided marketplace started.
And so when these founders come on, like, how did you go about, let's talk about that problem in terms of the two-sided marketplace, getting buyers to be aware that they could buy, part interest in these companies. How did you find the buyers?
Buyers is, if you have supply, I mean, buyers have no issue. Basically, we had a subscription business model where they would pay to get the contact details of the founders. So founders would list anonymously, a bit like a micro-acquire or acquire. And then to get their contact details, we would charge a subscription, and they could chat with them on the platform as well as take it offline. But that was the initial monetization before we introduced a success fee. But yeah, so buyers, especially when you cater to the more sophisticated buyers, i.e. like private equities and institutional investors, they know about partial buyouts, both minority and majority deals. And so for them, there was no education really needed. But actually on the sell side, that was our big learning for us, was how few people had read that blog piece, that blog post. So we actually had to do quite a lot of education on the sell side.
So when it comes to the buyer side, like, it's one thing for buyers to be educated and know what they want to do in terms of transactions, but like, how do you make them aware that you existed? Like, what kind of channels did you approach? How did you approach them?
So on the sell side, Twitter was amazing. This was before Elon acquired and took private Twitter, now known as X. But we were really riding the wave of we were basically messaging a lot of people directly, because back then like inboxes were very accessible. So you could DM pretty much anyone, except for maybe like famous people. Some of them had their DMs closed. But I actually reached out to DHH himself before we started via Twitter, and he actually, like, we got on a Zoom call for an hour. He took out of his calendar to speak with us about the deal he made with Jeff, just so that we knew like the mechanics of that, and how we could replicate it for others. So yeah, Twitter was a great acquisition tool on the sell side, and then on the buy side, LinkedIn was far more efficient, and also email outreach. We actually did that on both sides of the marketplace.
So pretty low cost,
Yeah.
ways to go out and acquire just targeted customer outreach. Smart. And then ultimately, you're at a point where you're growing, you're profitable, and you're like, what made you decide to sell to Flippa? Did they hunt you down and put a proposal in front of you? Did you run a process? Being that you help companies sell, what made you decide to sell?
Yeah, so I mean, Blake Hutchinson, the CEO of Flippa, had actually taken notice of us even before we officially launched. So he was one of the early users of BitsForDigits in, I think this must have been around September 2021. So yeah, I mean, when he created, when he signed up for BitsForDigits, we were like taken aback, also a little bit scared. Like, was he going to copy us? But then actually, the one who was gonna, who announced that they were gonna copy us was Andrew Gastecki from Acquire, who on Twitter announced that he was gonna launch like partial sales as a feature, but then never did. But yeah, so actually, yeah, Blake was already had us on the radar, and then we got an offer from another competitor, and then basically decided to kind of browse for who else was interested in acquiring BitsForDigits, just because we were at kind of a crossroad where we had started hitting like revenue, and we had actually gotten to profitability, and we were very lean operation. I think at the height of BitsForDigits, we had like 9 or 10 employees, which was like half of them interns. So we were a very like small business, but we were at a crossroads where we were like, okay, this can either become a small business, like kind of a boutique business, where we just continue bootstrapping, or we take one of these VCs up on their offer to fund it and really try and take it to the moon. And yeah, we have spoken at that point with almost 100 VCs, which I don't know if it's a lot, but when we first started, we got like basically chased by VCs to ask like if we were raising capital, and we were not. We wanted to see if we could bootstrap this at least till revenue, and get some traction before raising on, I guess, better terms. And then the markets kind of took a dip, and everything changed in the middle of 2022, a year later, and that's when we were like in 2023. Well, like we can still raise, but it'll be on terms that are pretty similar to when we like set out with just an idea. And so either we continue bootstrapping, we raise and try to take it to the next level, or we exit. And that was like the three options on the table for us. And VC money comes with a bunch of drawbacks, like a bunch of downside as well as upside, obviously, that you need to be aware of. And bootstrapping, I could say the same thing about that. It's I think perhaps I don't have the temper for it. I think I kind of wanted to either go to the next level or exit, but like doing revenue based financing in the most direct sense of the word is kind of like slow, and at least for us, right? We didn't catch any huge wave. There was no like COVID to make suddenly like remote work affect our business in any way or form. So it wasn't like we were riding any crazy wave externally. It was really like hard labor that went into building a reputation, getting the word out there, doing marketing and sales, and we were very engaged in customer acquisition, and it just kept being that way. We got a bit of word of mouth towards the end of it, where we didn't have to labor as hard to acquire new customers. But yeah, like by the way, like we didn't just do direct outreach. We also did a bunch of like events and meetups in both Berlin and London in Europe, right, where we were based. Indie Hackers was actually a great community for us. I don't know if you know of Indie Hackers, but it was acquired by Stripe and then sold again by Stripe back into the wild, or sold, I think, just let go. I don't think it was very like a good business for them or a good community in the end, but it was a good community for us. And so Indie Hackers, along with like a few other online communities, we actually managed to kind of get a good following going.
So you touch on something I deal with founders all the time. It's those three doors you see, exit, raise, bootstrap. And, for every company, they all have a little bit of different flavor, different, things you have to do to get past or, get to that door, unlock that door and move on, behind that door. And I find it fascinating that you kind of clearly laid that out. You recognized those three options, but also it sounds like you had some self-reflection of like, do I really want to go with those strings attached to either Bootstrap or VC? And so ultimately you chose door number 3, exit. And in that process, walk us through, you mentioned they approached you, but then you shopped around a little bit. Talk about that process.
Yeah, so we had one competitor reach out to us, and we actually met with them, and yeah, like we drew up a good like cash exit, which was nice. But then that was just an LOI, and then we decided to like figure out, take our own advice, if you will, eat our own medicine, and try and like approach more. We actually listed it. We listed our own business, which drew some attention. But like, it's very hard to list a business like ours without spilling the beans, because it's so, I guess you could call it niche what we did. So we ended up like doing like just a quick like tab on the shoulder to some of the folks that we were already connected with on LinkedIn. Including Blake and from Flippa, and that's how we then ended up with getting in serious talks with Flippa. So
okay, so Flippa didn't approach you; someone else approached you. That sparked the outreach, into which Flippa you knew and presented, exactly. And they decided to jump on it.
Yeah.
So comment for our audience of just know your users, know who's who's listening to you, who's following you, and be sure to keep them up to date when opportunities might come about.
Yeah, for sure. I mean, and if you can like use like, because again, you're kind of limited to your connections. I mean, I don't know how many followers people have or connections on LinkedIn and stuff, but I mean, you can either like broadcast or DM, I don't know, like a few hundred people, or you can like broadcast it to like 500,000 people if you're listed on a marketplace like Flippa. So if you are exiting, I would say, and you want to get like maximum number of offers in the doors for consideration, there's just no good alternative to a platform like that. But yeah, obviously you can start with the ones that you are in direct competition with and just like ask them.
And then so effectively it was a strategic exit for you. And just out of curiosity, when you approach them, like something I deal with founders is like, oh, I don't want to sound desperate. I don't want to be like, please buy me. How did you approach?
Well, it was very easy not to seem desperate when you aren't desperate. So I think the fact that we already had an LOI, it was a cash exit, was good ammunition to enter discussions with others about, because we weren't, again, like my co-founder and I were not settled on selling. We had gotten an offer which came like without us having to ask for it, and then we were contemplating that versus the other two doors, right, which was like taking one of the VCs up on their word to fund us, or continuing down the path of bootstrapping, which, to be honest, like neither myself or my co-founder had the kind of temper to continue doing, because it's like there's just no break in the sense that like it's a slow grind. It's a slow grind, and we've been doing that for years. And if at some point you're kind of hoping to catch a break, but that break never really came, I would say. So like you just got to grind it out, and if you want to do that, you can do that, or you can raise money and take it to the next level and accelerate growth a bit. And so I think, the exit was just definitely on our list of options that we wanted to figure out, okay, how good a deal can we actually get here to really seriously contemplate if we should choose that or if we should go with one of the other options.
Yeah, no, I think that makes sense. And that's the thing is like founders got to take into consideration how they personally feel about an outcome or a transaction. And I think that's something that a lot of, maybe as a broker or, VCs don't really care about, which I think is, unfortunate.
Me too.
It's like, what do you want to do for the next 5-10 years of your life?
Exactly. It's a great question, right? Because you really if you take venture capital, you are basically on a schedule for the next 5 years minimum, I would say. And so you got to really reflect upon that and see, is this what I want to spend? I'll be 34 by the time I'm done, with the first 5 years of that venture. And if I raise again and raise again and raise again, the clock resets, my vesting period, another 4 years, another 4 years. Yeah. And so you just got to be you got to come to terms with that. And, if you love what you do and, you have success with what you're doing and, the growth is up and to the right, then fantastic. I mean, I would not, personally, I would not tire of that. But the slow grind of bootstrapping at the pace that we were growing was not the blitz scale that you've seen other businesses do for sure. I think very few bootstrap businesses have that experience of blitz scaling, and I think for me, I have a temper of I want to stuff needs to happen. I can do with grinding it out for a few years, but grinding it out for another 5 was not really high on my priority list. So for me, the exit became actually a pretty good choice, pretty good option after we spoke with Blake as well.
I think the first step is always build a business that's desirable for either an investor or buyer, and then from there, understanding what options are on the table, and that's why I really wanted you on the show, was because I understand kind of that mental process that a founder goes through when having to decide, left, right, down the middle, where do I go, and what's best for me. And now what you're doing at Flippa Invest, as we kind of talk about capital strategy as an option for our audience of, what are the options on the table? Is venture, everyone says venture, but that's all because that's all they know. Venture has all the press and all the media and all the sex appeal, but
yeah, it does.
So many more options. And to be honest, I know a lot more bootstrap founders that sold that are a lot happier than venture-backed founders that are still grind.
Same.
So let's talk about, kind of, all right, you get acquired, walk us through kind of when that happened and kind of what the plan was, post acquisition and kind of where you are now.
Yeah. So yeah, we got we put pen to paper on the deal in December 2023. So at the one of the last business days of the calendar year, and then I took a break, basically for the first 2 quarters actually of 2024,
Nice.
And then joined Flippa around late spring, early summer, I think around that time. But yeah, I needed to just get my bearings. So went traveling a bit. I had really just kept my head down for almost 3 years. So it was nice to just get out of my hamster wheel for a little bit and just breathe some fresh air, and then get back into it with Flippa. So when I joined Flippa, the role that I had agreed to was to head up basically a new business unit within Flippa. So Flippa, for those who are not familiar, is a platform to buy and sell online businesses. It's the world's biggest. It's been live since 2009, so 16 years now, and has over 2 million registered business buyers and hundreds of thousands of business owners registered. I think at any given point in time, there's 6,000 businesses listed for sale. And so M&A is really in the lifeblood of Flippa, and they wanted to expand the range of services and products to also include fundraising. So A lot of founders come to Flippa, they get their valuation, like what's my business worth, but they're not really ready to sell. Maybe they want a bigger valuation, so they want to grow into a bigger valuation. And so we have so many buyers, and actually a subset of those 2 million buyers are what you would qualify as accredited, meaning they're accredited investors who are eligible to buy unlisted securities. And that allows us to solicit them with offerings that, hey, here's a business that's raising capital. You can invest in that business and help them basically grow it by deploying your capital and get ownership on the upside. So Flippa Invest was really the product that I was hired to kind of grow and launch, or launch and grow. So yeah, I started designing it, working with our head of product, working with our sales teams, working to make sure that we could kind of leverage obviously our base of buyers and the subset of those who are accredited investors to offer business owners, here's a new platform that you can raise growth capital on from our existing investors. So we have 75,000 accredited investors, which comprise mostly exited founders as well as current business operators, and then also institutional family offices and private equities. But what we don't have is VCs, right? We don't have venture caps. And so the people you raise capital from don't have those unrealistic expectations that, you're going to be the next Uber or you're going to be the next DoorDash. You're going to like 1000x my return. Most likely that's first of all, that's not going to happen. And our investors are fair and square, not even interested in that. Because Uber and DoorDash are still not profitable to this day, I think. So they would be way more interested in a more modest return on capital, as well as some dividends, some profit distributions. And that's where Flippa Invest distinguishes itself from other alternative fundraising platforms like AngelList, where you will find those typical, Silicon Valley investors who are actively looking for the next Uber or DoorDash. Our investors are not. And so I think it's a great alternative for the position that I was in with my co-founder, where we were like, okay, either we take these VCs that we've spoken with and that are asking us on a quarterly basis if we're raising, we take them up on the offer and we go balls to the wall, as it were, or we exit, or we bootstrap forever. And so here's a fourth option. Well, how about you raise from someone who's more aligned with your motivations, with your aspirations for the business? If you get an offer on the table to exit for $20 million or $50 million, a VC will probably try and actively block that, because that's not going to return their fund. That's not an outlier. So for them, that's not a good outcome. But for you as a founder, that is a good outcome. So our investors are way more aligned with founders who may want to take an exit at some point down the line. And even if they don't, profit distributions is also a great incentive for our investors to invest. So yeah, that's really what Flippa Invest is, and that's what I joined to kind of help build.
You're likely having trouble raising money or selling your company. Personally, I've had 4 exits and I've raised over $145 million. If you want a free coaching session with me, just subscribe, and leave a comment down below letting me know what you think of today's video for a chance to win a free coaching session with me. I'll select 3 winners every single month. You just have to subscribe, and leave a comment down below for a chance to win. Now, onto the video. Well, this is why I think it's fascinating to have you on the show and to present founders this alternative, this other source of capital, because VCs are easy to find. So they think VC, and they go to VC, they run, you talk to 100 VCs, but in most cases, it's not the right fit. And so you just spent 100 hours, 200 hours chasing the wrong people. And when it comes to, this type of option, so Flippa Invest, or this kind of partial, sale, what's kind of can you give some examples of the type of companies that it makes sense for, or the size, the average transaction? What are you, kind of expecting here?
So we have a few requirements on Flippa Invest, and one important one is that it's post revenue. It has growing revenues, in fact. So we don't have a fixed band for your monthly revenue, because it really differs. Like SaaS business versus an e-commerce, the margins are typically very, very different. So we don't have fixed bands for what your online business needs to make, but it needs to have growing revenues. And so because that de-risks the investment for the investors, in that you have traction. It's more of a proven business that you're raising growth capital for. And it's not pre-seed money to help an idea turn into an MVP, turn into a business. There's already a product. There's already a business. So that's how Flippa Invest can also have a different type of investor, because it might have like maybe a bit of a capped upside, but there's also capped downside. Like it's less risky, you could say, than the typical moonshot business that you find on other fundraising platforms, because these are real businesses. But sorry, Jason, can you remind me of the question?
Just like what's the typical transaction size? Or
So we have we have the funding target. We do have fixed bands for those. So now that we're like just launching Flippa Invest, you can raise between $50,000 and $1 million. That's the kind of like the band that we're the scope, you could say, that we're initially launching with. And I think with time we're going to increase that to like a few million. But in the early days here, we would rather under promise and over deliver than the other way around. So we don't want to see like huge rounds listed and launched on Flippa Invest that just collect cobweb. We want to fill the rounds that launch with us. So we're starting small, you could say. But the businesses that are raising, like one business is doing 2.1 million ARR. It's a cybersecurity SaaS business, fantastic business. And so they're raising, I think $300,000 with room for oversubscription, I think. But obviously, we also have businesses that make less, like way less money. So we have one that makes, I think, about 100,000 or 150,000 a year, right? So that's an MRR of like something like 10 or 12,000, and so they are raising, I think, 250,000, and then another business is actually raising $1 million. So we have different round sizes, different company sizes. Some rounds are like full rounds, and some are just like bridge funding. Some are follow-on funding. So we have like businesses that are bootstrapped, and some are more in the like carousel of like fundraising multiple rounds. So it's a bit of a mix, but we really like the businesses that are first-time raisers. So the ones that have not raised before, are considering raising, maybe to never raise again. Those businesses go really well down with our investor community, because they have like, maybe they're really close to profitability and they have a path to profitability. As soon as they get profitable, it's like, why would you ever raise again? So like those businesses are great fits for Flippa Invest, but we have a range of different types of sizes and stages.
So putting on my buyer's hat. So like I come in, I'm like, all right, I want to invest 50K, 100K, and see some kind of either future dividend or equity appreciation in deals. So I'm coming in and I'm picking, like, I want to see cybersecurity SaaS. Like that. I believe in cybersecurity and I like the SaaS model. So I'm perusing the options. Let's say I come to this $2.1 million cybersecurity option. Who sets the price?
So we're not investment advisors. We're not lawyers. We're not going to tell founders. We're not going to tell founders how to price their business. So we're not appraising their business. We have a legal partner that can help you, create term sheets and basically figure out how to structure your offering. We don't do that. We just basically bring it to market, and so that's where like kind of our service falls short at the moment. I think in the future we would like to offer some of these things ourselves rather than have partners do it. But at the moment, that's how we do it. So the price of the business is brought to us. We reserve the right, if your offering is outlandish, to not bring it to market, right? Like we still have a reputation here. We're trying to create a platform that's beneficial to both sides of the coin. So yeah, the price of the business of the round, it's something that is set by the founders that are raising capital, but we reserve the right to basically tell them that this, it's not a fit for our investor mandate.
So this is why I appreciate your guys' model. Like, it's still kind of like founder choice, but or maybe we'll talk about this, but like things I see on other, what we'll call more traditional crowdfunding platforms. Everyone knows kind of their names. What I've seen a lot of founders do is they'll go out and say, we're raising, $2 million on a $50 million valuation, or some like kind of crazy absurd
That's
valuation.
a great example. We would not have them on our platform. Yeah,
exactly. So like that's what I appreciate, because there's so many of those that do that, because like, oh, they're retail investors, they don't know any better, and they just kind of make whatever price, and there's almost no dilution to the founders when they do that kind of stuff. But in reality, it's a pretty bad investment decision.
Yeah, no. I'm also talking to a lot of Y Combinator founders. They're obviously on a different path. A lot of them, there's a whole range of startups that get Y Combinator backed and funded and go through the acceleration program, and they come out the other side. Some of them turn into these moonshots businesses, and that's fantastic. We need those businesses. I still am a firm believer in venture capital, and it serves a purpose. But there are also businesses that come out to the other side, and perhaps they might have shot for the stars, but they're going to land on the moon. And it's still fantastic business. And some of them are going to raise on Flippa Invest, but they're not going to raise at the $50 million valuation. They're going to raise at a different valuation. So we do have those great Y Combinator backed businesses launching rounds on Flippa Invest, which is amazing. But they're raising perhaps with a different temperament than some of the other more early stage businesses that are they just have a pitch deck, and they have an idea and a few guys from college, right? And they, a bit like my co-founder and I, we also have these resumes. He worked at Google, I worked at BlackRock. We're gonna go out and create a fintech, because tech and finance, they go together and they become fintech. And then we had 100 VCs literally dial us down and ask us when are you raising capital? And at that point, yeah, maybe you can spin up a story and you can raise that at an absurd valuation. But the good thing about when you actually have traction and revenue is that things become way more clear. What kind of business do you have on your hands? Is this is it growing? Okay, if it's growing 100% month over month, all right, well then maybe this is a moonshot business. But if it's growing more steadily or more slowly, or whatever the case, if you have a sense of how big the market actually is, because one thing is a slideshow, another thing is how proof is in the pudding. So I think Flippa Invest really fills a gap in the market that's underserved, because at the moment for the buy side, their only option to really get in on the action here is to buy and operate these types of businesses. Can you not get exposure to these businesses by just investing in them passively? So I think that's why it's really interesting for the buy side. And obviously for the sell side, I as a founder, I would have loved to have investors on my cap table who aligned with my aspirations for BitsForDigits, which were part of the reason that we didn't raise was we weren't convinced that BitsForDigits was going to be a decacorn. Okay, a decacorn means a $10 billion valuation business, and that's few businesses have that kind of market potential. And I think BitsForDigits didn't, and we came to terms with that. But then taking the VC dollars was kind of it was you need to have strong conviction that you can deliver those results. And I think we weren't 100% sure that we would basically sign on to deliver that.
I think it's completely fair and reasonable. And And most founders need to come to that realization. And there's always that dilemma that, oh, I got to be the next Steve Jobs, or I got to be the next, Uber or DoorDash, whatever. And they kind of set themselves up for that mindset, because you kind of have to have a crazy mindset to be that big, but you also have to have a great business, great team, money, a lot of other things. And so I always love exposing founders to things like Flippa Invest, or debt, or various different forms of equity, or just selling the company and seeing what can materialize, and whether it's a big exit or a little exit. Think about the opportunity cost of continuing to march down a path of a maybe lackluster business, when maybe they sold off the assets to someone that could do something more with it, and then go free up their time to go work on something different, and what that opportunity cost might be. So it's always great to hear about these types of options.
And there's a lot of risk trying to create something new. Like that's what I tried to do with BitsForDigits. I was like, there's nothing in the market that does this, that serves this purpose. And the same with Flippa Invest here, trying to create something that doesn't really exist. And it's still early days. We're gonna see how well it kind of resonates with both founders and investors. But I'm very bullish on it, because we do have like a big investor base that are very excited about it, and we have a lot of like founders who are also very excited about it. So I think given the scale of Flippa, it's the right kind of incubator, if you will, for this business to launch.
Do you foresee some kind of a feedback loop of, someone comes in, raises $250 on Flippa Invest, and then comes back like 2-3 years later and sells the company on Flippa?
Absolutely. It's a flywheel, right? It's the flywheel effect here of we can now service businesses in all of their or soon all of their different stages of the life cycle, both when they're growing and when they're maturing and exiting. So that's the beauty of Flippa, the ecosystem that we're in. And I think in the future, hopefully we can service them even earlier in the process.
So we got to be clear, our founders, maybe they're interested, they want to explore this, but nothing like this is free. Like how much does something like this cost for a founder to consider?
Yeah, so we have a launch fee, just like you see on other fundraising platforms. So to bring your round to market, and in front of our 75,000, actually it's more like 78,000 last I checked this morning. So 78,000 accredited investors, to bring that to market, help you prepare, get everything set up. It's $3,500, so $3,500. And so I always say this to founders, even in the event that you don't meet your funding target, you can still talk to your investors, and they can still write you checks. It's not like we're gonna block you from taking a small round. We can flex up and down. But also, even if the investors are maybe not all investing, some of them you can still these relationships you can bring with you, and I think that's quite valuable, because good luck trying to reach 78,000 accredited investors on your own. It's very hard to get in front of that many eyeballs that are high net worth individuals with more than just capital, I would say, because on Flippa Invest you find these business operators and founders who have run their own business or are running their own business, and they have network, they have expertise, they have what VCs claim to have as well, which is added value. And I think so that's why we call it smart money, right, in the industry. So it's more than capital, but yeah, these relationships will carry through. And in the event that you do meet your funding target and you do raise a round, we have a platform fee as well. And so depending on whether you raise via an SPV or without an SPV, we have a different percentage that we charge. So if it's without an SPV, we charge a payment processing fee per investor that invests in your round of 2.5%. And in the event that you use an SPV via us, so we have a partner, Sidecar, if anyone knows, they will form and manage the SPV on your behalf, basically, for the round that you're raising on Flippa Invest. And for that, we retain 4% to help pay some of these fixed costs associated with spinning up an SPV. So yeah, that's basically there's an upfront fixed flat fee, and then there's a down the line a percentage platform fee.
No, I think that's far within reason and kind of market for these types of services. So I appreciate you sharing that with anyone that might be listening. If they wanted to learn more about you or Flippa Invest, where would they go?
Go to flippa.com/invest. That's basically where Flippa Invest will live, and where you can also apply. We have a screening process where we'll get on a call. We'll have a look at your deck, your P&L, make sure you're a good fit before onboarding you. So you can go to that URL, flippa.com/invest, and apply to raise growth capital on the platform.
Okay, awesome. Well, Laurits, it's been an absolute pleasure having you on the show and sharing your journey, and also this tool that is now something that founders can consider as a potential pathway for fueling their company to hit the next milestone. So appreciate you coming on. Appreciate you sharing your advice.
Thank you so much, Jason. It's been fun.
Thank you for watching today's episode. As a reminder, I'm your host, Jason Kirby. I have built and sold multiple companies with over 135 million in transactions as either a founder, operator, or investor across multiple industries. I'm currently the managing director and founder of Thunder.vc, where we help companies and founders at all stages navigate what capital to raise and who to raise it from, and help improve companies' odds of raising capital. If you need help, reach out to us at help.thunder.vc. If you like today's show, please share with your friends, give us a like or a comment down below. And as a reminder, this show is published weekly. And to get notified of new episodes and our newsletter, be sure to go to our website at join.thunder.vc. And if you sign up today, I'll send you a few freebies on how to negotiate a term sheet, how to get a free list of relevant VCs, and much more. That's it. No more shameless plugs. Thank you, and see you next week.